everyone, I'm Michael Glass from michaelglass.com, where we focus on helping our visitors become financially literate so they can make informed decisions about their financial future. Before we begin our video, we always want to start off with our disclosures. Any symbols you see today should not be inferred as a trading recommendation. No matter what form of investing you choose, stock, forex, futures, options, they all have a level of risk associated with them. You can lose all of your money. The strategies we're showing you today are for educational purposes only. Future results are not guaranteed. And finally, any investment decision is solely your own responsibility. Trade at your own risk. As you guys know, we like to always start off with a little humor or some type of quote, and today we have a little bit of both. And of course, we have a little graph here about the results of a lot of our fellow Americans' 401 accounts and what's happened, especially over here during the month of May here in 2012. And then we have a quote from Warren Buffett which says, "Wide diversification is only required when investors do not understand what they are doing." And that really goes to our being financially literate, being able to make educated decisions about our financial futures, our investment portfolios, our 401k accounts, our investing accounts. That's what everybody says. You got to diversify, and there's nothing wrong with diversifying. But if you know what you're doing, if you know how to invest, you can. There are people who have made millions trading IBM, trading Apple, trading one stock, not diversifying, but taking the time to learn the heartbeat of one investment vehicle and then manipulating the heck out of it. It's not in terms of making it go up and down, but just understanding once you know the heartbeat and the swings and the movement of that stock or that forex pair or whatever it may be, you can do really well. You don't have to diversify if you know what you're doing. So today we're going to talk about a breakout strategy. This is a day trading strategy, and it's called the opening range breakout. So to define it for us, we basically are looking at the high and low price level for a given period of time. Usually that period of time starts at the opening bell. Now you'll see some different variations of that time period. I've seen 15-minute opening ranges, I've seen the first 30-minute opening ranges, and I've seen the first 60 minutes. And perhaps long, depending upon what type of trader you want to be. And of course, you also want to marry that with the actual stock or currency pair that you're using, because the opening range is usually the discovery time, the time that the market is filling the close, the orders that were put in at the close of the previous day, and then the orders being put in now. Sometimes they're market orders. People see things. Day traders just put in market orders to get into the trades the next day. Some trades that weren't filled at the close of yesterday. And so it's a discovery period. Some people call it the amateur hour. And so the premise is, while this discovery is going on, the bias of the market can be determined when it breaks out of that range. So we're looking for that high and low of that discovery period, and when we break out of that range, we can form a bias. So we basically draw that opening range, but again, looking at that high price level, and that's why we have OR high for our green line, because that is the high price of that opening range, and then our red line, the OR low, is the low price of that opening range. And again, you have to determine if you like the 15-minute, the 30-minute, or 60-minute. We do that by back testing, but we do that by, Thinkorswim has on demand. We do that by using your particular investment vehicle. I have the ES here, a stock, a forex pair, whatever it be. You have to try it out and see which time frame for the opening range works best for establishing a bias for your investment vehicle. Now, the basic rules are pretty simple. When we are looking at that high and low opening range price, we're saying that that is a significant price level. And when price action rises above that opening range, we now have a bullish sentiment. When price trades below that opening range, we now have a bearish sentiment, and we need to be looking for bearish trades. So what the opening range does is it allows us to filter out the different types of trading setups and focus in on specific trading setups. So if we're above the opening range, I'm looking for bullish trading setups. I'm looking at breakout trades. I'm looking at pullback trades to the upside. If I'm below the opening range, I'm going to filter out all of my bullish trades, and I'm going to look for bearish trades. Again, breakouts to downside, and retracements, pullbacks to bearish support levels, resistance levels. So the opening range is a breakout strategy, but more importantly, it allows us to filter out and focus on what type of trading setups we need to be looking at for the day. Now, one thing that's important that I don't have in here is that we also have to consider the type of day. Because I said this is more of a breakout strategy, on those reversal consolidating days, you may want to avoid the trading setup, or as I talk about here in our summary, you might want to fade the opening range. So the opening range is basically determined by two components: time, 5 minutes, the first 15 minutes, the first 30 minutes, the first 60 minutes. Again, usually we'll see people talk about 30 minutes and they use 10 o'clock as that opening range. But again, I've seen 15 minutes and I've also seen 30 minutes. One thing to consider with that is that, usually we have 10 o'clock news and sometimes we have that 9:55 news. So that's why I think a lot of people use the first 30 minutes, because it allows for the news to happen and you're trading the breakout in conjunction with that news. The other thing that we're looking at here in defining the opening range is price, and we're looking at the high-low price of that specific time frame. As I said before, the opening range is considered a price discovery period, and the breakouts occur when price action closes above or below that opening range high or low. How do we initiate a position? Well, we have the initial breakout. That's the most aggressive entry, but it gets you into the trade. We also have the pullback after the breakout, and now we've confirmed we've got the breakout and we've got the pullback, and now we're confirming that as we move higher. And as I mentioned just a moment ago, you can also fade the opening range, and I would consider those more on those reversal consolidation days, especially if you're looking at the NR7. Is it an inside day? Is it a breakout day? Is it a trending day? That type of day will help you determine whether or not you should or should not be taking the breakout trade. Another good thing to use in conjunction with the opening range is market profile, and we're going to have a video for that. Well, we already have a video actually up on our site for that. So that is our quick summary on what the opening range is and how to trade it. If you want to learn more about how to implement it into your trading system, how to develop a trader's mindset and a psychological capital to implement the opening range, we highly recommend you go to learnhighprobabilitytrading.com. There you'll find our coaching program where we'll help you identify the correct high probability trading steps that work for you, define who you are as a trader, so that you have that psychological capital to pull the trigger on each and every trade. Thanks guys, and I'll see you next time.